My name is Carrie Hamilton. I'm really glad to welcome you to the second day of the National Housing Conference 2017. And thank you to Annie Weldon for our welcome to country yesterday. Look, I think you've all, maybe many of you, been to several conferences about housing, and you know that we usually feature a stream on finance. Some of you might avoid those streams on finance. They may be the sessions you feel are full of jargon, or you may be drawn to them, like those of you who got up early this morning for the breakfast session because you find that the finance sessions are full of innovation and cutting-edge ideas. But this is a plenary. We're all here from all of the various specializations within this important industry. And I'll start by promising very little jargon today. I've made my panelists promise very little jargon. And I also want to disavow anyone of the belief that finance actually needs to be complicated or innovative to have impact. Today we're talking about the National Housing Finance and Investment Corporation. So we're going to use our newest acronym, NHFIC. Okay, NHFIC. We'll get used to that acronym today. And I have to say that this new intermediary that's been introduced by the Commonwealth this year is actually quite vanilla. It's quite intuitive. It's not necessarily having to be complicated to promise great impact. So we're going to make sure that each and every one of you walks out of this plenary today understanding how it will work. So really the most novel thing about the NHFIC is the fact that it was the central agencies. It was Commonwealth Treasury who decided to take housing out of the too hard basket for the first time. So I have to say, this is how policy really should work. This was not an episode of Utopia. This was developed through a very careful collection of evidence by Scott Morrison's Affordable Housing Working Group through last year, basing a lot of its evidence on research that Ahuri had conducted. There was impressive levels of consultation with our sector nationally, and this will be up and running by next July, 2018. But will it fly? That's the title of our session today. So this could mean two things. Will it fly? Will this new entity solve our shortfalls of affordable housing? No, the NHFIC is not the national housing policy, the all-encompassing national direction that we have sought. We're not able to be Canada just yet. We can't all migrate to Canada like the wonderful keynote yesterday. We're going to have to still advocate for that national direction on housing here. But the NHFIC is a very important piece of the puzzle. Will it fly could also mean, will the NHFIC work the way it's meant to work? Will it attract Superfund investment to affordable housing? What needs to be in place in order for that to happen? So the NHFIC is a bridge. Think of it as a bridge. It's an intermediary between the coalface community housing providers, CHPs, and institutional investors. That means Superfunds, who require large-scale, standardized format to be able to invest. So think of the NHFIC as a bridge. It's proposed to have two components: a housing infrastructure facility with loans and modest grants to councils, and a bond aggregator. So I don't want that to be jargon. I want to explain what that is. The bond aggregator is its main function, and that term is often used interchangeably with the NHFIC. So basically, a bond aggregator aggregates or pools together mortgage loans made to the CHPs into standardized bonds that the Superfunds can then invest in. So the Superfunds need these large rated bonds. They can't spend our retirement funds negotiating individually with each CHP on smaller scale projects. They need the scale so that our retirement money can be invested efficiently. That's why I was thinking maybe it's a sausage-making machine is better than a bridge to describe as a metaphor for the NHFIC. But it's going to pool things together. Now, these loans to the CHPs exist now. The CHPs have been borrowing from commercial banks for about 10 years, using the rental income that tenants pay plus CRA as repayments for loans. The loans are then used to build new dwellings. So that's how it works. These bank loans that we have in the market at the moment are currently short-term. They're very tricky to negotiate. Each one is essentially a one-off. So that's what the NHFIC will do, is standardize this. and bring regular Superfund money into housing. So look, there I summarized about 400 pages of Julie Lawson's Ahuri papers into those 3 minutes. So that's exactly what the NIFIC is going to be. But I do want to make sure that we're clear that this is not going to be one of those housing finance streams that you may have been to in previous conferences that have what I call the silver bullet fallacy, that we can solve everything with this bright, shiny new finance mechanism. The only silver bullet really would be reintroducing stable and robust government investment to fund the feasibility gap and increase the supply of affordable housing. We haven't had that in Australia since changes to the CSHA in 1993. That's the precursor to the National Housing Agreement, National Affordable Housing Agreement. We've had some brief one-offs during the GFC stimulus and NRAS, but that's the silver bullet we really need. And again, you can't all migrate to Canada with their $11 billion. You can't do that. We need you here. So the NIFIC is not reintroducing that. Remember, a bond aggregator will need something to aggregate in order to fly, in order to have credibility with the super funds. So refinancing the existing loans out there will fill 1 or maybe 2 bond issues. What's after that? So we're going to talk today about some conditions that will help the NIFIC fly in Australia. We do know that this mechanism works. The precursor entity in the UK has been up and running since 1987. Piers Williamson, our keynote speaker today, will show us how the Housing Finance Corporation, his company, his nonprofit in the UK, there has normalized private investment in affordable housing. It has built capacity in the nonprofit sector, and it has issued bonds at lower rates than even the UK government. That's how safe housing is. After he speaks, I'll introduce more fully, and we'll also hear from Stephen Knight, who chaired the Affordable Housing Task Force charged with getting the NIFIC up and ready by next July. We'll hear from Michael Swan, who represents CBUS, who is our kind sponsor of this session. He represents the superannuation industry that the NIFIC is hoping to provide the bridge to, or make the sausage for, whatever metaphor works for you. We do thank CBUS for its sponsorship of this plenary. We will hear from Jon Ross of Westpac, who is a commercial banking executive who took an early position supporting the community housing sector. And we'll hear from David Cant, who stepped down very recently as CEO of the Brisbane Housing Company, a nonprofit CHP who is the only one to date to actually secure its own credit rating. After Piers' address, we'll discuss some questions. For example, are we ready for the NIFIC? Will it satisfy what the super funds require? What CHP regulatory changes are necessary? We'll have plenty of time for audience questions as well, either through the app, make sure you're all logged in, or with mics. But first, to introduce Piers Williamson, this is his 3rd visit to Australia to assist our investigation and now implementation of a housing bond aggregator. He has been CEO of the NIFIC equivalent, the Housing Finance Corporation in the UK, for 14 years. And as I said, it is an interface to raise funds from their insurance companies to expand social housing. It was set up after a right-to-buy program actually depleted stock there. It has since provided over £5 billion in loans to British housing associations and not suffered a single default. So Piers describes himself as a specialist in risk, but not taking them, avoiding them actually, and just as our NIFIC will be a finance corporation, not a housing corporation. He is a Treasury risk governance specialist rather than a housing practitioner. But as he'll tell you, for his sins, he actually served on the board of the UK's National Housing Regulator for several years. He knows housing. He's also a keen bassist with an enduring commitment to musical education for young people. He was singing along just this morning. I saw it, and clearly he has a very deep commitment, so just as much as to young people, to demonstrating bond aggregation to Australians over and over again. We're so lucky that he's come back down here. Thank you very much. Here's Piers.
Good morning, everyone. Right, I would like to add my thanks to the Sydney Street Band, the Sydney Street Choir. You're right, Carrie, I was singing along. I sing some of those songs on a Saturday morning. I'm not this Saturday, though, because I'm going to be getting on a plane somewhere, I guess. Right, here we go. So, what gives me the right to stand here? We're 1-0 down in the Ashes. We have a nation that is just about to jump off the proverbial cliff, leaving Europe. And I don't think it's my job to preach. My job is really simply to share experience and to share my knowledge. I've been doing this job for 15 years. I love it. And I can see many parallels between experiences of affordability at all levels of the economy, whether they be our children or people right at the bottom of the pile, just trying to get by, just trying to have somewhere to live. We have common issues. So I'm going to give you kind of a mixture of themes this morning, which draw on my own experience. I'll start by talking about our involvement over the last 3-4 years, latterly with the government over here. I'll talk to you about debt aggregation. It sounds like something out of Terminator, doesn't it? It's a horrible, horrible phrase. I'll actually talk to you about what I call cat herding, because I'm a cat lover as well. So we'll talk about our own experience. I will touch on regulation, because I think that's quite an important building block in what could happen here. And I'll walk you through our use of guarantees in the UK, which has been really very successful, and our experience with government, which has been an interesting journey. I describe myself as about 20% civil servant these days. I don't know whether that's a good thing or a bad thing, but I've got to know an awful lot of very bright civil servants. And then I'll talk about what we have achieved through the different programs that we run and the expertise that we have, and why that's important, actually, in terms of building the overall credibility of a sector. And then I'm going to finish to give you your own version of You Raise Me Up. I'm going to talk about the experience of one individual housing association over the last 50 years, which is an absolutely incredible story that they have to tell, called London and Quadrant. So let's just kick off. This is kind of the factual stuff. So right now, I'm an advisor to the Australian federal government. I've worked through a couple of permutations of this idea that we're talking about, the NIFIC, as we called it. And what I've been doing is really sharing our common issues about actually running one of these things. THFC, my organisation, is just had its 30th birthday. So we started doing bond aggregation in 1987, as Carrie suggested. And there have been good times along the way, and also less good times. Right now is a pretty good time. And there's a lesson there around cyclicality and working against the business cycle. So from time to time, as we discovered in 2007, 2009, banks fall over. And actually, that's a point in time when our business has prospered. We are an alternative provider. We have no divine right to write the business. We have to compete with the banks all of the time. And fundamentally, what competes most of all is price. And one of the themes I want to keep coming back to around the aggregator here is it is only really you all working together to achieve scale that will deliver that price over time. I don't want to be particularly prescriptive, but just offer learning points. I recognise that it's a bit like having a jigsaw puzzle with some quite common pieces, but the two nations are filling in that jigsaw puzzle in a different sequence. So I don't want to be prescriptive, but I want to be observational, I guess. And I do want us collectively to shift institutional perceptions. You are quite an infant industry over here. All industries have to start somewhere, and you're well on the way, but fundamentally, to be credible and attractive to large institutional funds, you have to go through a process of maturity as a sector. Okay. Most of this, I think you know. This slide I put together really to try and... I was actually giving a talk to the Australian UK Chamber of Commerce, and they were a bunch of people who mainly build tunnels, and they didn't meet people all that often. So I was trying to talk to them about what a CHP is. And actually, you're a reasonable sized sector, but you are concentrated at the top end of the feeding chain. So there are 46 tier ones, and presumably some of you are here today. But like the UK, there is also this very long, or quite long tail of really quite small organisations as well. Your core mission is serving the two income quintiles where lack of affordability is most marked. That's absolutely the core mission of UK housing associations, but increasingly we find that they are serving, because affordability runs across it's classless. So Kate Allen, a journalist at the FT, came up with this great saying that all housing is affordable to someone, or unaffordable as well. But housing associations in the UK are starting to appeal and almost segment their brands to deliver different products to different segments. So I know we've had David Cowens from Places for People over here, and he's actually a pretty good expert at defining all those different product ranges. So we have this proposal that I think is wending its way through government at the moment to set up NIFIC. And at its core, and sorry, this is a bit of a technical point, what is the point of this? The vehicle mitigates refinance risk. So to the extent that most of you borrow some money from banks, you're borrowing it on quite a short-term basis, but you're investing that in bricks and mortar in very long-term assets. So fundamentally, you're going to have to refinance that debt over time. By appealing to an alternative market of the super funds and taking on longer-term fixed-rate borrowing, you're eliminating that refinance risk, and you are locking in what are, in the UK, I described, we have the lowest interest rate since the Black Death. If people know when the Black Death was, it was about 1350 or something. Interest rates are historically very low across the globe, and that is an opportunity if managed correctly. And I don't think we're due to talk about the infrastructure fund today. That's quite an interesting development in its own right, in parallel with the bond aggregator. So why aggregate debt? Horrible phrase. I like talking about cat herding, as I said, because I'm a cat lover. When I first used this slide 3 years ago, someone came up to me afterwards and said, Australians don't like cats. I hope, does anyone here like cats? I can't really see you. Good. Okay, well, those that are cat lovers understand that people are free spirits. Actually, this conference is evidence of free spirits. If we tried to get a homogeneous view in here, we'd come up with 20 or 30 different views. That's the beauty of the housing sector. But fundamentally, my job is to create scale investments. So my job is to herd cats. Over on the left of this slide, we've got the kind of the factual elements of herding cats. So the number one objective is to lower the cost of finance and to move to a fixed rate of interest and to eliminate refinance risk, as I've said. But we also need to increase capacity. That is one of the goals of this exercise. And we need common standards across this sector to encourage those long-term investors and to smooth the impact of the economic cycle. That's the easy stuff to say. The harder thing to do is to herd cats. It's to get commonality of interest. It's a soft barrier to entry if you get this right, and the intention is to get it right. But it is very difficult to get that commonality of interest. And this will only succeed if you all, or a good proportion of you, want it to succeed. I'm going to move on now to talk a little bit about how we sell in the UK the strengths of housing associations to institutional finance. And in fact, this is a slide I use. We commonly get, I just had Canadian Imperial Bank of Commerce in the other day, CIBC. We've got far enough through or far enough beyond the GFC that banks who don't have historical exposure to the sector are thinking about coming in. And you can use this slide to say, what is the difference between a housing association and a volume house builder? Now, you have some of these ingredients over here, but certainly not all of them. But I want to put this to give you the context of the sector that I'm familiar with. And the sector, actually, I was looking back in the last 20 years, I think the housing association sector has put on 1 million homes in the UK, which is an amazing achievement if you think about it. And we're seeing a corresponding decline in the proportion of stock that is public housing, that's owned by local authorities. But these are the 5 legs of this stool, okay? This is how I describe the strengths of housing associations. And some of them may seem a little odd, or what's that got to do with it? And the first leg is regulation. And what we have in the UK is financial regulation. It's not consumer. What we have in England is financial regulation, not consumer regulation. The regulator's job is not to do your job for you. There's a jargon called co-regulation in the UK. Co-regulation means it's primarily the responsibility of the executive and the board of a housing association to manage itself. The job of the regulator is not to be a management consultant to tell you what to do, although often it can feel quite a tempting relationship. But fundamentally, organisations should be developed and grown up enough that they manage themselves. The regulator's job is not to stop you making mistakes, it's to stop you making catastrophic mistakes, and it's to stop systemic issues arising. But from an investor point of view, 30 years on, no institutional investor, no bank has lost money lending to UK housing associations. That's an amazing thing to be able to say. It's very hard to keep that going, but fundamentally that's the state of affairs. And one of the reasons is that the regulator has a prescriptive toolkit of statutory measures, from raising their eyebrows through to taking over boards at the other end of the spectrum, and they are proactive. Housing associations, when managed properly, they do go wrong from time to time. Most of the time they go wrong slowly. And the regulator's job is to spot the early signs of things going in the wrong direction, and to encourage voluntary adaptation of the business model to bring the association back on the straight and narrow. The second leg of this stool is grant. Now, this is one of the things that's missing over here, and it's pretty key. So subsidised housing needs subsidy is a common phrase I use. And when we've been deliberating this in NIFIC, we recognise that actually that is true. What we're prescribing is not sufficient to solve your problem. It is one of the elements of giving you a more sustainable business model. We're fortunate that many housing associations have grown up over a long period, and we've got that £45 billion, so that's about 75 billion Aussie dollars of grants sitting at the bottom of the business. We have a simple financing model, mortgage finance. Everyone who has a mortgage, it's only too clear what that mortgage is. You have to pay the darn mortgage payment every month. When we went through the credit crunch, when we were debating these complicated financial instruments, one of the advantages of what we did was it was transparent and clear what the financing basis was. I went into the British Steel Pension Fund about 2 days after Lehman's went bust, and I said, "Hello, I'm THFC. We're simple." And they said, "Sit down, simple is good," because they were dealing with all sorts of horrible things going wrong at that point. So it's understandable. Payment direct, again, effectively you are dealing with some of the most... come and sit down. Welcome. Did you have a good party last night? I'm sorry. Welcome, thank you. You are housing some of the most vulnerable people in society. What is a sustainable financing proposition around that? In the UK, what we call housing benefit, you have a different phrase for it, it's the right of the individual. But when they sign up with the housing association, when they sign that tenancy agreement, they assign the right to receive that payment to their housing association. So the cash goes from a local authority to the housing association direct. That's actually being challenged at the moment through something called, some of you may be looking at the debate around something called universal credit. So a politician called Ian Duncan Smith decided in a slightly holier-than-thou view of the world that tenants should be able to budget for themselves. They should understand what it is to to rent a place. So we're going to give you the cash so that you can budget properly. My experience of single mums in places like Liverpool is they know how to budget every single penny. And actually, one of the issues about giving them money is they know how the system works, and they know just how big an interest-free loan they can get by not paying their rent so that they can buy their school children shoes. So I think it's putting tenants in an invidious position, giving them very hard choices, taking that sort of route. That's my own view of the UK. I think that you have a system where tenants, where you have much more interaction collecting money off your tenants typically. Okay, so those are 4 stools. The last one is independence. And here we are, the NIFIC, we're thinking about placing that within government. That's an interesting concept, but not of government, but kind of in proximity to government. One of the enduring factors for me talking to investors is ours is a sector and yours is a sector where politicians always dabble. And dabbling is not always good. Actually, the housing associations in the UK are experts at managing that dabbling from time to time, but fundamentally, the vast majority of them are independent charities, and they're responsible for the charitable mission of that organisation. And that's a very important distinction, giving them that airspace between not being government, but you're constantly having to interact with government, and there's a subtlety in there that's important. Okay, a slide on regulation. It's like doomsday has come. What's the point of homogeneity? In the UK, we actually have 4 regulators of housing. So the English regulator, where I served as a board member for 4 years, almost 4 years, is by far the largest. But there's kind of a sliding scale from there in terms of the competence and experience of those regulators. I would say Scotland broadly comes second, although they don't like saying it, they follow English standards. The Welsh, there's a phrase in Wales called the tafia. Is anyone from Wales here? So if you're a taffy, you're from Wales, and the tafia is obviously what happens. It's a very closed community. And there's a very old-fashioned form of regulation that the regulator kind of knows what's going on because it's quite a closed community. And so they tend to spot things early. Trouble is when things go wrong, they don't necessarily have the experience of managing failure. There was an example last year where the Welsh regulator decided to call a statutory inquiry over a very badly run organisation, but it didn't realise that calling that defaulted all the loans of this housing association. It's like pulling the sky in on themselves. And they had to very quickly go into reverse gear. And I've spent some time with the permanent secretary in Northern Ireland teaching him how to do a workout because they'd never had to do one over there. So they're very mixed experiences, even within an apparently developed market. And to an investor, homogeneity is good. When I walk into one of the big life insurers in the UK, I can't be there all day. I have about half an hour to do my pitch. And then the guy from, I don't know, aerospace or from fintech comes in after me. So the window that you have on these investors is very brief. And what they need to see is that there is homogeneity, one standard. That's about credibility. That leads to investability, and it leads to more predictability. Actually, a better phrase for you as a sector, and one I hope many of you understand, is sustainability as a business. What we're all about. You are long-term businesses, or you should aim to be long-term businesses. We're aiming to underpin a model through the use of the aggregator to give you sustainability, to let you grow your business at an orderly rate. Having one regulator also gives you standards around workouts. I gave you the description of different workout styles around the UK and how there is very little experience of complicated workouts outside England. Common standards are important, and at the end of the day, to all governments and to areas around government, they love managing costs, they love managing budgets. Actually, good regulators cost money, and having them spread all over the place is a diseconomy of scale. And what I work very hard at being as a board member of the regulator is creating a cadre of sector experts. Are there any of the regulators I saw the other day here? I think there's some of you there. Hello. One of the things I said is, when my children leave college, they don't have a dying mission to be a regulator of housing. It's not like the first career option that kind of jumps up and grabs you. So part of the job of developing regulatory expertise actually is to show it as a pathway, to a pathway to perhaps someone who wants to be a credit analyst but can't get a job with Moody's or someone. Being in a regulator is a career path to do that. Or maybe you want to be the chief executive of a CHP. And we had a generation in the UK they were called the flower pot men, and they were all chief executives. There's a whole rank of them that are just retiring now who went through a patch working at the regulator, and that sure helps. Okay, I'm going to speed through this because I'm going to run out of time. Why did we guarantee UK debt? We were fortunate in winning a bid from the government to provide £3.5 billion, up to £3.5 billion of guaranteed debt to the sector. The reason that government viewed that it was important to have a guarantee at that stage was, this was 2012, they viewed that there was market failure at the point of intervention. It took us a total of 5 years to get this to maturity, so it was quite a protracted effort getting it together. We are able to issue up to 30-year debt. That gives us, in managing a contract, a very long tail. It means we have to have the resources as a team to manage a portfolio over certainly I'll be retired by the end of it. And we have a unique guarantee structure that works both upstream to investors, but there's also a downstream element to stop me having to walk into the Secretary of State saying we made a little mistake and there's going to be a claim on the sovereign guarantee. Not career enhancing. And it's produced some of the most cost-effective debt around. Sorry, this is my only graph. I do like graphs. What you can see in terms of the build-up of the bars is when Julie Lawson first found me, it was still 2013, I think. We hadn't done anything. So I was talking about something we didn't quite know how much of this we would do. What you can see, the right-hand axis shows these are drawn loans, and that 3,000 is £3 billion. By the time we're quite finished, we'll have issued £3.2 billion of debt. And the squiggly lines coming across, the black one is probably the one to look at. That's the cumulative cost of finance using guarantees. So we started at about 3.7% over on the left-hand side. Our cumulative cost for the entire £3 billion that we're showing there has just gone below 2.5% for 30-year debt. So that is quite something, really, in terms of showing you what we can achieve. And we've had to learn to work with government. So people know about Yes Minister. We've since had In the Thick of It, which is slightly more up-to-date. When we deal with government, no shit Sherlock, sorry, that's swearing, but the two are different, two different cultures. But certainly in the UK, post the GFC, the government has had to learn new tricks. We have nearly £1.8 trillion worth of stock of debt in the UK. We still have quite an alarming structural deficit, and we're just about to jump off this cliff of Brexit. So latterly, government is actually having to think on its feet a bit, and it is being more commercial. But in having an interface with government, we've had to teach them how to make decisions, believe it or not. We've had to design workable processes. We've had to deal with the turnover of staff. Staff last in the public service kind of 18 months typically, and here we are running a 30-year contract. And political support can be fleeting. When we first started this process back in 2013, the housing minister would be jumping up and down asking how many effing houses have you built this week, about every couple of weeks. That was what they were keen on. And then the political kind of barometer went way over the other way, where home ownership was suddenly the thing that everyone wanted. And it's come back. Post-Brexit, we've realised that actually the government does need to pay some attention to what they call the just about managings. And we're one of those few bodies that can speak knowledge unto power, to quote a phrase. What have we created? This is our whole credit analysis on a page. What we worry about with our clients is core cash flow, not surprising, access to cash. You either get access to cash by selling things or by drawing bank debt down. A lot of housing associations now are using outright sales or hybrid mortgage products like shared ownership to cross-subsidise their core social housing business. So we look at sales dependency, and most of all, we look at the competence of the executive and the board to understand those risks. So that's informed by financial plans, red, amber, green indicators, golden rules, stress testing. Sorry, this is all jargon, isn't it? I'll move beyond the jargon. And what have we really built? We've built a credit model over a short period of the economic cycle that's created a pecking order. Moody's has about 46 rated clients. We have 160 of them, and we do comprehensive analysis of these sort of factors. So EBITDA, MRI, sorry, it's more jargon, earnings before interest, tax, depreciation, major repairs included, with and without sales. That's a bit of a mouthful. I'll move quickly on. This is a bit of fun. Well, it's not fun. Actually, this is quite humbling. Guy in the top left, it's a chap called Nick Stacey. He was a midshipman at the end of the Second World War on HMS Anson, and he went to Hiroshima about 2 weeks, I think, after the bomb had gone off. And he decided that he was going to be a vicar. Before he became a vicar, though, he went to Oxford. And he discovered he was a bit of an athlete as well. In fact, if you see the pictures of Roger Bannister when he did the 4-minute mile, when he's collapsing over the finishing line, it's Nick Stacey picking him up. Nick ran, and this is a picture of him, ran in the 1952 Helsinki Olympics in the 200 metres. And he's notorious for he was a bit nervous before the start, so he thought he'd have a fag. He lit up the fag, had a couple of drags, gave it to the starter, bang, did the race, came back, took his fag back off the starter and finished it. So he's quite a character, as you can gather. He was in a dining club in Quagliano's, which is a restaurant in London, in 1963. And the speaker for their dining club, who was a trade union official, got stuck on a train and didn't turn up that evening. So Nick stood up. By that time, he'd been a vicar for about 3 years, I think, in Woolwich. And he told the rest of the audience about appalling housing conditions in the southeast London, where he worked. And he was so convincing at the end of it, he got 64 quid out of them. That 64 quid set up 32 shares in an organisation called Quadrant Housing. And they went and bought this property in the bottom right. It's 2 Wrottesley Road. That's their very first property. That was the start of L&Q. And today, L&Q has gone on to be quite a large organisation. Its mission, I hope it's kind of consistent with some of the mission statements you'd have, is to combine social purpose and commercial drive to create homes and neighbourhoods to be proud of. L&Q now, from Wrottesley Road, it's gone to 90,000 homes. It delivered 2,500 homes last year, of which 1,500 were affordable. Its existing pipeline is 44,000 homes. It owns 42,500 development plots, and it has turnover of about 1.25 billion Aussie dollars equivalent a year. And it made a surplus, remember this is a non-distributing mutual, of $549 million equivalent last year. That's what you can do. Took 50 years, but that's what you can do. So I'm going to close now. I'm told in young person's speak that spread the love actually means you've been out on the razzle the night before. I use it in a slightly more innocent context. I'm here to spread the love. What difference has THFC made? We started this investment market in 1987, 30 years ago. For the next 5 years, we grew as banks struggled through the property correction. So we proved that we can be counter-cyclical. The overall pace of investment was faster because THFC was there. So THFC acted as an accelerant to the market. It made things happen quicker. It didn't make everything happen, it just made things happen quicker. And we introduced the European Investment Bank to UK housing associations 20 years ago. Unfortunately, we're about to leave the European Investment Bank. That seems a bit of a silly thing to do, but we are. And we got the guarantee scheme in the UK off the ground. I've said here as quickly, or perhaps it wouldn't have been successful without THFC. I'm not convinced it would have got off the ground at all without THFC. So we're not the answer to everything, but we're the answer to some things. And I'll leave you on that basis, I think. Here comes Carrie. Thank you.
Thank you so much, Piers. We really appreciate especially the herding cat slides, and we appreciate you bringing your experience to Australia now in your third trip. I'd like to welcome our panel up to the stage, and we'll start introducing our esteemed panel today. First, we'll be hearing from Stephen Knight. Now, this new agency, the NIFIC, that Piers has graciously been advising on the establishment of, is slated to be established by next July, as I mentioned. It's December tomorrow. So it's not about Christmas shopping, it's about the NIFIC getting up and running. So what we're going to do is first hear from the man who is charged with advising government to make sure that it's done correctly. Stephen Knight was named by Treasurer Scott Morrison earlier this year to chair the Affordable Housing Implementation Task Force to develop the Bond Aggregator. And he now continues to serve along with Piers on a reference group to further assist Treasury. Now, Stephen is a government finance expert. He was CEO of the Treasury Corporation here in New South Wales for over 10 years. And at the Commonwealth level, Stephen was a member of the Australian Office of Financial Management, the Advisory Board. So the AOFM basically manages the Australian government's entire debt portfolio and ensures that we have a functioning finance market. That's all it does. So he is accompanied on the Affordable Housing Implementation Task Force by the Secretary of the Treasury, John Fraser, and by the CEO of the Community Housing Industry Association, Peter Windsor. So we've actually got quite wonderful representation there. So Piers makes it sound easy. Stephen, what are your thoughts?
Thanks very much, Carrie. And I don't know how easy it is, but just to put some context in terms of this, some comments. As Carrie mentioned, I was asked by Treasury to assist in the implementation initially through establishing proof of concept for the Bond Aggregator. So when I received the call a little bit under a year ago, I said, look, I'm not a housing expert, I'm a capital markets and government finance expert. They said, that's fine, we have plenty of people that understand housing. So I felt like I was drinking from the proverbial fire hose in terms of understanding all the work that had been done. And an observation that struck me very early on in the process is it seems like the time is right. So many things have happened over a period of time now that all of the good work that's been done around this and by Huri and others over a number of years seems to be at that point where there is a very, very strong political commitment, strong industry backing, and a real sense of alignment in terms of some of those key enablers. That still means there's a lot of work to be done to actually make it happen, but I felt encouraged by the work that's been done so far and the quality of the people that have been working on this from the industry for a long period of time. I think in all of that, it's been wonderful to actually have Piers's wisdom, background, and input into this whole process, and looking at the similarities and differences, I guess, in terms of the situation here and really that long history now that has been established in the UK and all of this. I do look at the certain aspects of the UK as a capital markets person with some degree of envy. The fact that there's long been a well-established longer-term debt market, both from an issuer and an investor perspective in the UK. In Australia, we're starting to move in that direction. In terms of the bond markets in Australia, as many of you are probably aware, we've long had a well-established liquid sovereign debt market and bank debt market, less so in corporate debt. But in terms of the tenor of that market, it's only in recent times that liquidity has extended out beyond 10 years. We now have the Commonwealth issuing a 30-year bond. They're baby steps, but certainly it seems that opportunities aligning for greater success in this sector. A number of Piers's comments really struck home with me, particularly the herding cats. I do have 2 cats and a dog that thinks she's a cat, so that creates a challenge in itself. But the debt aggregation model, again, I think there are many case studies both here and overseas where that model, given the right circumstances, actually does deliver positive outcomes. And my involvement with New South Wales in terms of running the Treasury Corporation, that is basically a debt aggregation model. Interestingly, if you look at the history of when debt aggregation models are put in place, often the debate or discussion at the time, they do have their detractors, and often those detractors are people that really just don't want to change because they say, we like the way we do things. That's always the challenge when you move into a new situation. But I think at the end of the day, the cost and the efficiency wins out if properly structured, and I think that's going to be the case here as well. As was mentioned, as Carrie, I think you mentioned at the outset, that conceptually the NIFIC is very simple. While there is devil in the detail, I think one of the challenges is to make sure that its message and its way of operating is kept as vanilla and simple as possible, and that's certainly something that we've been focusing on in the work of the working group. And I think I'll just leave my comments there and
Thank you, Stephen. I appreciate your comments, and also you getting sucked into the housing world, because it's like, as you say, Hotel California. You can never leave now that you're in. So thank you. I'd like to next introduce Michael Swan from CBUS. That's the Construction and Building Unions Superannuation Fund. Now, CBUS has projected total funds under management swelling to about $50 billion in 2021. That's about 4 years from now. And like many other super funds, many that you may have your retirement savings in, is moving towards more internal management of those assets, up to 20%. So will you be able to sleep at night when you're looking after $10 billion in a few years? I know you will, because you'll be invested in housing. So Michael is an experienced portfolio and risk manager, and I'm very gratified that he's here. We've had many very generous supporters from the superannuation funds. Michael's the first one who represents fixed income, so fixed rate borrowing for long terms. We often have property analysts come and look at housing because they think, well, this is property, isn't it? Property investment means selling things out from under people to capitalize on increased value, and we don't do that in our sector, where we prize continuity of tenure for our tenants. So I'm very gratified to have Michael here. Michael joined CBUS in the public markets team in April this year, and we're very interested in whether you think this is a goer.
Thanks, Carrie, and thanks for the invitation. And full disclosure, Piers, I'm a dog man, so don't hold that against me, whatever you say. But thanks to Ahuri too for the opportunity to be part of this important conversation. So a great little plug from Carrie there. We're currently at $41 billion in the superannuation fund in the building, construction, infra and allied industries, and we're open to all working people. So 750,000 members, many of which the housing issue is a big problem for them as well. So look, we invest back into the construction and building industry, not only to provide strong long-term investment returns, but to boost the Aussie economy, creating jobs within the industry. And again, as most know here, we've been actively involved in this important topic for some time. Discussions around the affordable housing, and participated in many research forums, reviews, and most recently we submitted to the Commonwealth Treasury a few comments on their consultation paper that I think Piers mentioned in his topic there, around the Bond Aggregator particularly, and our infrastructure team also did a bit on the infrastructure facility. So CBUS, we do believe that the super funds should and can play a role in helping improve the supply of affordable housing for Australians, and we can provide a source of funding, partnering in particular with the government to tackle this issue. There's an obvious need to build more houses and more infrastructure along the way, and given the right return outcomes for our members, we can provide patient capital in this sector. Just a couple of quick points. Time, I know, is getting away from us, just on the Bond Aggregator, but it's well understood that affordable housing falls short on investment return comparisons to other types of real estate investment. So we believe some form of government contribution, assistance or support would be typically required to bridge the gap between the commercial and non-commercial returns. And, as a consequence, we'd encourage the government to support, and we view positively the potential for a government guarantee to be attached to the issuance to the bond aggregator. So that realistically, government guaranteed should encourage a large pool of investors and greatly assist the long-term financing needs.
Thank you, Michael. I appreciate that. Thank you. I'd like to now move to Jon Ross of Westpac. While we're very gratified to welcome Stephen and Michael, new entrants to our housing industry, we also applaud the next two panelists who are the stayers. Jon Ross of Westpac made some of the early loans to the community housing providers and was really in there very early getting to know their business. He's the head of the public sector team for the institutional bank, as separate from the retail bank, and has 25 years of experience. He also leads all of Westpac's approach to social and affordable housing. And don't ever forget that Westpac has committed to provide up to $2.5 billion by 2020 to help facilitate the growth of this sector in response to affordable housing shortfall. So how are you going getting that money out the door? And do you think the aggregator is something that you can continue to work with?
Well, thanks, Gary, and thanks for the opportunity. It really is like Hotel California. You just don't leave. So, yeah, absolutely, we do support the Bond Aggregator. We think it's going to be an important foundation, an important element of this really important sector. And just a plug for Westpac in terms of this is a core part, social and affordable housing is a core part of our sustainability strategy. So we are involved and we want to continue to be involved in the sector. So there's three, we think looking at what's being proposed here, there are three key things that we think are important. One is for the aggregator to provide transparency on its investment criteria. So as it leads to the CHPs, they need to be very clear as to what the standards they need to reach. Also that the aggregator needs to leverage its financing power rather than disintermediate the banks. So hopefully it can work together with the banks and it can actually lend for market failure, which it seems to be the stated purpose. And importantly, it needs to help close the funding gap. We all know that there's a dramatic funding gap, which will facilitate the cash flow lending. So yes, we absolutely are supportive of it. And whilst in its simplest form, it's a financing mechanism. It will actually it'll support the banks, it'll support investors, and it'll support the superannuation industry. So it's got a real role to play, but it does certainly initially need a government guarantee, we believe, to actually facilitate that. That's what's happened in the UK, as you heard from Piers. That's what's facilitated that massive growth in the UK, and we're still very nascent here. So if we achieve that, then I think its absolute objective will close that gap and help the sector. I think one of the challenges here is the size of the market. So at the moment there's about, pick a number, circa $700 to $1 billion of debt out there. So it's still a very small market. So there's not actually that much to aggregate. But if it does that, it will actually improve the deal flow. And it'll help. What I think it will help, which is really missing at the moment, is a sort of replicable and sustainable pipeline, which will keep the market involved. So I think for the superannuation industry and for the banks, this often isn't our day job, but you actually need a pipeline so people can build up the skill sets, remain involved, and that goes for the government as well. And Piers talked about the turnover in government. So I think it can do it in three ways. It can take out for development financing, which banks are good. That's a natural place for banks to play. Also longer dated financing. So there is, call it market failure, but banks fund comfortably sort of 3 to 5, maybe 7 years, and then they don't go beyond that because that's how they fund themselves in that tenor. So as we know, these are very long assets and there's a need for longer dated financing, and the aggregator can absolutely play a role there. And it can play a role, I think, thirdly, in providing subordinated loans, subordinated debt, or accepting lower market returns than what banks can play. The biggest issue for banks in this sector is the reputational risk issue. So we simply cannot exercise security. So it's pretty academic, we take it, but we don't believe we can exercise it. So therefore, we actually need the loans to amortise. And that's generally in our modelling, that's sort of 20 to 25 years. They have to fully amortise, so there's no rump left at the end. So that's a really hard thing to achieve. So the aggregator can actually come in and actually take that back end, and that will really facilitate deal flow and really facilitate the growth of the sector, I think. Also, if the bond aggregator can provide subordinated financing, it will actually help with the reputation risk for the banks because it will provide support to it. And Piers again touched on this in his speech, and it's sort of related to the aggregator, but governments have a tendency to keep changing their minds. We call it sovereign risk, and it actually is very costly for the sector. And we've probably all witnessed it here, and we've had some very recent examples in this market. Most recently last year with the SAF, where the government came to market wanting to deliver 3,500 homes and delivered 2.2. And there's a lot of effort put in by all sorts of people across the market on those bids, only for them not to be delivered. We had another example up in Queensland with Logan, where there's a tremendous amount of effort and money expended by people in this room, I'm sure, only to have the government change their mind. And we've actually seen that in this sector. We're also seeing it in other sectors. So, most recent was the East-West link in Victoria, where the government changed its mind. Those sorts of behaviours, I think, we have to actually change, because the banks and the whole market puts a lot of effort into this, and I think the aggregator will have a role to play in helping that stability.
Thank you, John. It is about credibility on so many levels. Credibility of a subsidy stream to create a pipeline, credibility of the government as your interface, your partner, just as much as the community housing sector. Thank you. We'd like to hear next from David Cant, who, as I mentioned, until August this year was the CEO of Brisbane Housing Company, which really specialized in mixed tenure developments, cross-subsidy using market rate commercial and residential assets that they developed. David was CEO of BHC since its inception in 2002. And it's notable for having raised the first credit rating for a CHP in Australia. So prior to coming to Australia, David had a career in affordable housing in the UK and also worked as a regulator. That's another theme we've seen coming up today. So David, we're all interested in hearing how your reflections have evolved in the last few months as you've had some time to think.
Well, thank you very much, Carrie. And three quick points. And I think it's wonderful to hear leaders in the finance world speaking so positively about affordable rental housing, because it wasn't always the case. And I remember early in the life of Brisbane Housing, Bill Kelty came to talk to our board because he was on the board of a superannuation fund. And he was empathising with us because he said the finance industry completely mispriced the risks of social housing. And I think in the UK they demonstrated with that success rate and lack of bad debts how well not-for-profits can perform in collecting rent and helping sustaining tenancies of very poor people. I think the sovereign risk is actually a bigger factor, and I think you characterised it really well. It was great to see Standard & Poor's acknowledge BHC's financial robustness by giving a AA- rating, which is exceptionally high in investment grade. So I think it's wonderful that the finance industry are recognising that we can do this challenging work and perform really well. I've got just two other points which will probably come across as a more, I suppose, challenging or provocative way. One of them is about how many CHPs are actually going to be able to use this money in the early stages. As been pointed out, there are about just over 40 Tier 1 providers. And I think without a substantial sort of grant component, it won't be just a guarantee that will bridge the gap. Quite challenging projects will be needed to achieve the sorts of yields that will enable people to pay back these bonds. Something closer to 6% than the 2% that perhaps you can get on the sort of projects that BHC has been doing in the past. And to create those sorts of returns, you have to do complex projects. You have to do, as Carrie's mentioned, BHC in one of its most recent projects was market renting half the units, had some commercial space. It was charging discount to market rents on half, but selling some of those properties to other charities to recycle some of the capital. And those challenges in putting a project like that together are not ones that many, or maybe half of the top 40, the Tier 1s, have demonstrated that capacity. So I think in the early days, one of my questions is who is going to be able, in the absence of a generous income, a grant scheme, who is going to be able to generate the yields that are needed? My third and final point, I think, is really comes from a preoccupation I have with a key difference between our industry here in Australia and the UK. I mean, I love the analogy of the 5 legs of the stool. I can't see that any of the legs really, other than independence, exist in Australia. I won't go through, we haven't got enough time for me to go through and illustrate, prove that point to everybody. But I think we should be willing to think very differently about how we're going to grow this industry here, because those stools, the grant system, the strong balance sheets historically aren't there, the housing benefit system isn't there, the regulation is still relatively underdeveloped here. So many of those legs of the stool are missing. I think we have to think radically, and I think there's a huge amount of trapped value in the public housing portfolios in Australia. At the moment that value gets sort of teased at with some outsourcing of management, sometimes stock transfers, but done in a way that is inconsistent, gradualist, often on pernicious terms that favour the lessor. In other words, the poor properties are handed to the CHBs who have to take the burden of risk. I actually think a way of fast-tracking this whole industry is to liberate the value in that tiny but significant for Australian terms public housing portfolio by transferring it into government-owned corporations under boards that are commercial, can make decisions. I mean, BHC's example is that a company, it's an independent charity, but it had government shareholding, it had a board that was close to the challenges, made commercial decisions. And I think that if the public housing portfolio were put into government-owned corporations that could then access that debt, we'd see an accelerant of an important kind. Thank you.
Thank you, David. Provocative. Look, we have a number of wonderful questions. Thank you for all of you who've been using the app. I appreciate everything that you've sent up. And I'd like to summarize a few of the questions. And I think there's some roving mics as well, if the lights can come up. Look, some of our questions respond to one of Piers's comments, which sounded to me like, war is over if you want it. The aggregator will work if we all come together and help it be competitive. How would you respond to Australian community housing providers who say, look, I can raise money cheaply in the commercial bank sector now, especially after the NIFIC was announced and the banks tightened up a little bit. What are the extra benefits that the NIFIC will bring?
On the point we were making early on, it's a bit dry and techy, but fundamentally, you were making the key point that banks have an appetite to lend short term. Actually, they're experts at development finance and that side of things, but fundamentally these are very, very long-term assets. So I don't think it's a case of either or, actually. I think it's the most appropriate mixture would be the ideal solution. The aggregator can deliver longer-term debt on a fixed-term basis that eliminates a certain number of risks that are endemic. The sector is exposed to cycles, and what this does is it helps them ride property cycles by locking in the cost of debt for a longer period for a proportion of their funding.
And if I can add that in, almost reinforcing and dovetailing with what John was saying, is that the bond aggregator and the role and the banks can operate in a complementary manner in terms of it may give the banks greater, because of that that lack of a long-term takeout, if you like. It may give the banks greater confidence when they're looking at financing the development phase of a project, in the knowledge that the bond aggregator is there to be an ongoing financier. That requires a couple of things, and John's point is a very good one. It means that the credit criteria and the standards of the NIFIC must be really clear, because no one wins if the banks finance a project on the assumption that NIFIC will take it out, but it just doesn't meet the NIFIC's credit criteria, then you get finger pointing all over the place. So that's a very, very clear thing. And the other thing in terms of of a pricing relativity, as we said, I think there's strong support for and a very strong case for a guarantee to be applied, and that will present a certain level of financing which will be attractive, and importantly give that longer tenor, which is just not available through bank financing. So I think there are key differentiators.
I think also it will facilitate the development of the asset class that we're all striving for, so we can access the superannuation industry. So it's going to be long-term fixed interest. So if it's guaranteed and it provides an appropriate return, it's going to provide an asset that does not currently exist in this market, and that will hopefully open up some of the capital to the sector.
And the fixed interest sector loves consistency of issuance. So if, just 3, 5, 7, 10, but if they keep coming, the name's in front, that name's front and centre, and, will be invested in.
Fantastic. So it would mean not having to refinance every 5 years. It would mean CFOs being able to, focus more on the repayment, the data collection, than needing to go back into the market, and having longer tenor debt. Exactly. Look, we've had several very interesting questions. How would the NIFIC interact with various state or territory requirements around very low income targeting for tenants, and also for disability housing and Indigenous housing? How could these be incorporated in the NIFIC's bond issues? Perhaps, David, you've done a lot of mixed tenure.
I think it's really is the challenge of Australia that sovereign states with their understanding of local conditions and their desire to differentiate solutions for their communities, it does fly in the face of consistency. And I don't know what the answer is. There's always a desire for a local solution. And I guess maybe there'll be a category of things that are important to finance that are perhaps separate from the human issues that we can address locally. I think maybe that's the thing. It's a hierarchy of criteria that will enable national systems to overrule really what is parochialism, understandable parochialism.
Carrie, if I can say, I'm sorry. One of the odd things that we found early in the guarantee scheme is that we found ourselves teaching the sponsoring government department what credit risk was in housing associations. Now, we were Chinese walled from the regulator, so that was why the subject matter expert wasn't in the conversation. But very quickly, government started to understand some of the subtleties around the difference in risk between some of the sub-activities that housing associations undertake. And the very first thing that we needed to bottom out was, okay, government, what is your risk appetite? And to come back to the transparency point and the predictability point, it is very important that government gets its head, if government is providing a guarantee particularly, it gets its head around the differential risk even within this sector, given the particular activities that may be financed.
I'll follow up with a question from the audience that relates around government guarantee. Is there analysis on what interest rate effect would be without a government guarantee? I know you were certainly aggregating for years and years before a guarantee came in force. So is it an interest rate effect, or is it other effects the guarantee would satisfy?
Technically, it's a credit risk effect. It's a proportion of the overall interest cost. In the UK, we would estimate, and the graph I showed you could prove it, that the benefit in a mature market where housing associations themselves have the same sort of strong ratings that you were describing, the benefit over and beyond that was at least 1%. It was probably 1.5%. Now, the benefit, I suspect here, needs to be greater than that, but it is relatively easily quantified. We, as a guaranteed issuer, we issue at 0.3% above the cost of the government's own debt. So you can back solve to, if you figured out what the standalone cost would be, roughly what that differential would be.
I'm sorry, I can't really see if there are questions from the audience, but do let me know if there's microphones waiting. I've got plenty here to work with. Thank you for submitting these questions. I do have a question about, is there a skew of interest on the NIFIC towards larger CHPs, or would this be open to smaller providers as well?
Well, I think the modelling that has been done has suggested that the availability of lending certainly for the tier 1 and tier 2 CHPs be clear, and there's still work being done around eligibility for
Nice.
That's a good.
for finance to go further down. Ultimately, one of the things that you would hope evolves as a result of the establishment of the Bond Aggregator and a clarity around credit requirements and credit guidelines is in improving and lifting in the financial sophistication of CHPs through a number of rationales. What that means, they partner together. But that's really, I think, one of the opportunities in the sector. There's clearly, as is the case in a number of areas, but there's clearly a wide range of degree of financial sophistication across the CHP sector, as well as a large degree of dispersion in terms of size. So I think the ultimate end game for the Bond Aggregator is that if you get a degree of consolidation, whatever form that looks like, whether it's partnering together, a lifting of those of that financial capability and financial understanding, and a clarity coming out of the Bond Aggregator of what those credit criteria are, then you get a greater chance to move further and further down the size spectrum. But that's still a work in progress, I think, in terms of determination of actually how the Bond Aggregator will work.
It's an important means of diversification of the bond issues, actually. David, I was wondering, tell me about the experience of securing the credit rating. Could you have just waited a few months for the NIFIC, or tell me about how you communicated?
I think getting a rating as a single organisation is not inconsistent, or it's not incompatible with the idea and desire for aggregation through the corporation, in that it's a discipline that it gets you to collate your information, tell your story, subject yourself to critical scrutiny, and then you have the annual updates with, in our case, or in BHC's case, Standard & Poor's. I think it's a really good discipline, and I'm interested to know actually whether if people have their own rating, then it will make them more attractive when they come and do their deals with the aggregator.
I would say our own experience, I was talking about what have we created, it's a much more thorough approach actually than a rating agency. One of my clients was jokingly saying in a meeting, "You're so thorough, Piers, it's like undergoing colonic irrigation." And I said, "You liked it so much you came back twice."
We've got a question from the audience. Wendy?
Wendy Hayher, CEO at New South Wales Federation of Housing Associations. Piers says subsidised housing needs subsidy. Jon says we need to get that feasibility gap filled. And David's trying to come up with ideas about how we cope if we don't. We've got a really eminent panel. I'd like to ask each of you what we can do to convince government that it needs to invest in affordable housing.
John's ready to go. Go ahead, Jon.
I don't know what you need to do. It's so obvious, isn't it? I mean,
Yeah.
We're talking to the converted in this room, and all of us are living it. Where our children are going to live, where the people at the... I was watching SBS on Struggle Street last night. I mean, it's such a fundamental need. It's what the French Revolution was all about. So I don't know what we need to do to convince them. I know what needs to happen to actually facilitate it, and that is, as we all know, that we're asking people with the least amount of money to make rental payments. And of course, if you're paying maximum 30% of their income, and we know that's not a lot of money, but we need to build something that costs an awful lot of capital to deliver. And so the gap between the income coming from the tenant and what's actually required to service all the outgoings, whether it's banks or superannuations or whoever it might be, or the aggregator, is too big, and the market needs to, and the market won't fill that. It absolutely has to come from the government. Now, we can debate for a long time what form that takes. In the UK, it was done through stock transfers, it was done through grants. The US, it's done through tax concessions. Here we have the New South Wales Infrastructure Future Fund, which is a great initiative. Victoria's got something similar. It doesn't matter as long as we close the gap. And when we close the gap, the capital will flow, because the market needs market returns.
Because we're short on time, I might just go to Michael to respond. What will you need to see from market subsidy, government subsidy?
I think similar to John, we're there. We continue to be there. There's a great analogy that we always use when coming up with obstacles. If you put your pressure against a wall for long enough, it'll eventually fall. And so that's the way we're sort of looking at it as well.
We certainly have momentum that's been building, but we have also been calling out the elephant in the room for quite a while. The Commonwealth Treasury themselves, in a companion paper put out the day the NIFIC was announced, in the first paragraph acknowledged that an ongoing subsidy to fill the gap is necessary for the NIFIC to work. Okay, so this was actually acknowledged by Treasury itself in the Affordable Housing Working Group's paper. That was encouraging. But look, I would really like to thank us all working together, and especially Piers coming down and giving us the inspiration of how this looks 20 years on. Sorry, 30 years on. Thank you. It is achievable, and we understand even better today what the conditions are required to be in Australia for this to work, and to work for all our organizations that choose to participate in the Bond Aggregator. I really appreciate CBUS's ongoing commitment into the space, and for sponsorship of this panel as well. So we have the roadmap and we have the support. We need some key conditions satisfied. The Commonwealth is not off the hook. Even after it establishes the NIFIC, it's probably not off the hook. So it's Commonwealth and state governments working together, having difficult negotiations in rooms today about the ongoing National Housing and Homelessness Agreement that will help this to fly. So I'd like to thank our whole panel, and please join us for tea outside. Thank you. Thank you.